Welcome to today's Explainer. We're diving into something that literally impacts every single aspect of our lives, yet it almost never gets explained in a way that actually makes sense. We're going to unpack a massive question today. What is finance? Seriously, what is it really, and how does this whole system actually work behind the scenes?
When most of us hear the word finance, we immediately picture Wall Street traders screaming at each other on a crowded floor, or maybe just incredibly boring accounting spreadsheets. But what actually is finance? Well, it turns out it's basically a massive, multi-tiered ecosystem. And to really grasp it, we're going to take a journey today through three totally distinct levels of this environment. We'll start out by zooming way out to look at the macro ecosystem of money, those big, invisible forces that dictate the value of a dollar. From there, we'll zoom right down into your own pocket, figuring out how everyday economic frustrations can be completely flipped into personal empowerment. And finally, we'll journey into the extreme meta-math of Wall Street to see exactly how the absolute pros hack the system.
So here is our roadmap for today. We're going to hit the ecosystem of money, then the psychology of wealth. Next, we'll get super practical with building your personal wealth. And finally, we'll wrap up with the math of Wall Street. Let's jump right into part one, the ecosystem of money and the rules of the game. To truly understand this system, we have to look at the invisible rules dictating how money behaves. And honestly, that requires a massive paradigm shift. Currency isn't inherently real. Think about it for a second. The only physical difference between a dollar bill and a stick you find out in the woods is that we as a society have collectively agreed that the dollar bill has value and the stick doesn't. Currency is entirely a social construct. It's built 100% on a shared belief and trust. If that trust just suddenly disappears, the money becomes absolutely nothing but paper.
And because money is a system built on trust, it is constantly pushed and pulled by some massive invisible economic forces. First up, banks. We all kind of like to think of banks as giant steel vaults just guarding our cash, right? But they're actually matchmakers. When you deposit $1,000, the bank might take 900 of it and lend it to someone buying a jet ski. That's called fractional reserve banking. They really only keep a fraction of deposits on hand. Then you've got inflation. Now, this isn't some overnight explosion of prices. It's more like the slow, quiet erosion of your money's value over time. Your $5 bill is still technically a $5 bill, but suddenly it's buying fewer groceries. And finally, recessions. Think of the economy like a giant house party. During an economic boom, everyone's dancing, everyone's spending, but eventually the lights flicker, reality hits, and the party has to end. A recession is really just that painful, natural reset.
The really crucial point here is how you interact with all these forces. And that almost always comes down to interest. Simple interest is pretty straightforward. It's basically a flat fee for borrowing or lending cash. But compound interest, that is literally money cloning itself. It's amazing. If you're paying compound interest on a credit card, it's a ticking time bomb. Your missed payment earns interest, and suddenly that $12 burrito ends up costing you $50. But if you are earning compound interest on your investments, it acts like a financial cheat code, just multiplying your wealth while you sleep.
Which brings us to part two, the psychology of wealth, and how we actually play the game.
Now that we've got a grip on those big macro forces, let's zoom in a bit on our own minds. There's this absolutely fascinating concept that fundamentally changes how you'll view your wallet from now on. Money equals life energy. You are literally trading hours of your finite life to earn cash. If you make $10 an hour and you want to buy an $80 leather jacket, you aren't just spending $80. You are spending a full 8-hour workday of your actual life. When you start framing every single purchase as an exchange of your life energy, your spending habits change almost instantly. The problem is, our brains are incredibly sneaky. We use these mental accounting tricks to justify our bad habits. For example, we treat a $2,000 bonus from work completely differently than $2,000 that's already sitting in our savings account, even though it's the exact same amount of life energy. To hack this, you kind of have to trick your own brain back. First, keep very little cash in your daily spending account. Second, treat your savings folders as totally sacred and untouchable. And third, whenever you can, use physical cash for your discretionary spending. Why? Well, casinos use plastic chips for a reason. Swiping a card or tossing a casino chip completely hides the psychological pain of parting with your money.
So to really master your own psychology, you need a conscious spending plan. The goal here isn't to stop buying the things you love, it's to automate your entire system. Imagine ruthlessly cutting costs on the things you honestly don't care about, like, say, that gym membership you never use, so that you can spend extravagantly and completely guilt-free on the stuff you actually love. A great baseline is automating 50% to your fixed costs, 15% to investments, 15% to savings, and then enjoying that remaining 20% completely guilt-free.
All right, part 3, building your personal wealth and actually winning the game. Okay, so we've got the mindset locked down, but to actually win financially, the golden rule of getting rich is shockingly simple, yet most people completely ignore it. You just need to buy more assets. By definition, an asset is anything that puts money into your pocket, and a liability is anything that takes money out. A rental property is an obvious asset. But did you know a YouTube video can be an asset too? If you make a video once and it generates $40 a month in ad revenue, it's acting exactly like real estate just without the $12,000 down payment. You want to start filling your life with things that pay you. But as you're acquiring all these assets, you really have to watch out for the silent killers. Check out this jaw-dropping number, $418,000. Think about this. If you invest $100,000 for 30 years and you pay a 2% management fee instead of a 1% fee, that tiny, seemingly insignificant 1% difference costs you over $400,000 in lost compound growth. That is nearly a quarter of your potential wealth just completely wiped out, all because you didn't check the fine print on fees? Of course, it's incredibly hard to buy assets if you're buried under a mountain of debt. And that's exactly where a highly effective strategy comes in called the debt snowball method. Here's how you do it. First, list out all your debts, but exclude your massive mortgage so you don't get totally discouraged. Second, deduct your basic living expenses from your income to see exactly what cash you have left over. Third, pay the absolute minimums on all your debts. And then, here is the magic step. Take every single remaining dollar and aggressively attack the smallest debt. Once that smallest balance is finally gone, you gain this incredible psychological momentum to tackle the next one, snowballing your way all the right to financial freedom.
Finally, part 4, the math of Wall Street. This is how you hack the game.
We've covered everyday personal finance, but how do the actual pros operate? What if I told you that some of the richest investors on the entire planet simply do not care if the economy booms or crashes? It's true. Everyday investors panic during a recession. Quantitative analysts, or quants, they don't. They use high-level mathematics, AI, and alternative data to find hidden patterns and place bets that profit regardless of which direction the market is moving.
To pull this off, quants don't just look at those jagged line charts of stock prices like the rest of us. They literally model the market using math. They look at returns, which is just the daily percent change in a stock's price. When you map thousands of those daily returns, this amazing pattern emerges, a bell curve or a normal distribution. The center of that curve, the mean, represents the expected return, and how wide or spread out that curve is, that's the standard deviation, which represents the risk. They literally quantify the chaos. It's absolutely fascinating stuff.
By quantifying all that chaos, they can execute brilliant maneuvers like the pair trade. Let's walk through this simply. Say quants predict company alpha is going to outperform company omega. First, they short omega, meaning they borrow shares and immediately sell them to get $1,000 in cash. Next, they use that $1,000 to go long and buy alpha shares. Now imagine a massive market crash happens and both stocks drop $5 a share. Alpha goes from 50 down to 45, and omega drops from 40 down to 35. Because omega dropped by a larger percentage, when the quant closes both trades, buying back the borrowed shares at the new, lower price, they actually walk away with a $25 profit. Even though everything in the market lost value, they won, because they bet on the mathematical relationship between the two. Now just imagine scaling that up from 2 stocks to 500. That requires something called mean variance optimization. It's wild. Quants build these massive, multidimensional mathematical models. They use an objective function to perfectly balance expected returns, risks, and the complex correlations between hundreds of assets, all at the exact same time. They run these constraints through a Python script to find the ultimate, optimal portfolio that maximizes profit while strictly capping their risk.
So whether a quant is using alternative data, like tracking mobile phone geolocation data to see exactly how many people are walking into retail stores, or using high-frequency trading computers that execute trades in microseconds, their true job is exactly the same. They find hidden patterns, they model mathematical uncertainty, and they turn those predictions into highly profitable trades. That is the bleeding edge of finance.
And that brings us to our final thought for today. From the macro invisible forces all the way down to your daily latte factor and right up to Wall Street algorithms, finance is just an incredible, multi-layered system. As the entrepreneur Jim Rohn famously said, "When I lost all my money, I realized that I'd only lost 10%.
The remaining 90% was the skill that would help me rebuild everything. You see, true wealth isn't the physical paper sitting in your bank account. It's the financial literacy and the skills you've just learned to navigate the system forever. So ask yourself, now that you finally know how the system really works, how are you going to engage with it? Thanks so much for joining me on this explainer, and keep learning.